Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This is all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024 had been, and I suppose still is after a fashion of sorts, is the breached and seemingly repaired dark blue September to December 2024 bear channel, currently at 1357 to 1750, that has developed into a descending expanding wedge pattern. However, since February, another pattern, the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 23 weeks ago, seemed to be a better contender in showing the bearish angle of attack. But on this one, last week saw prices finally push up over the upper time, currently at 1609. Such that we have a breach higher, not yet a break, but a breach. And the reason I say not a break is because we have, for the last 4 sessions, seen prices turn back lower, back down towards the breached upper time, having been capped by the overhead descending mauve medium moving average, currently at 1703. However, personally, I have my doubts about this pink bearish Andrews pitchfork, whether it will still exist there in a few weeks, but we shall see. There's also another large pattern complementing the other bearish patterns, a longer term bright red November 23 to September 24 bearish shift pitchfork, which has even now, after so long, been pretty good at showing the bearish angle of attack over a longer time frame. On this one we are today, as we have been for most of the last few weeks, hanging around, just over today, but hanging around the bright red middle time, currently at 1594. Plus, back below, after a week above, the green declining short medium moving average, currently 1632. Overall, I suspect something is going to give, and soon. Going back to the more recent action, we have a really interesting drop 7 Mondays ago below the pink middle time and the dark blue lower trend line. Though no doubt both of these eroded the bearish incentive, but it was in the end the March 2021 low at 1467 that finally halted the decline and turned prices back up again, up to where we are now. In the process of doing all this, the market created a weekly key reversal up 7 weeks ago. The first weekly key reversal up since at least 2018, and that is something to take notice of. I said 2 weeks ago on this matter, and I quote, "So, is this a long anticipated, by some at least, bullish turn higher from all the bearishness we have seen here since late February?" At the moment, I'd say, like I said last week, no, it is a recovery, a small one, so far from a massively overt bearish market. And the weekly key reversal up is an interesting indicator to start watching out for signs that this may be more than just that. But for now, it is a pullback in an otherwise still bearish market. We much more than what we have seen so far to justify any such change to the bullish in the market's aspect. And that's the end of the quote. I still stand by those words. Ice Europe white sugar in London. After all this time, there still continues to be 3 features of this market to continue to bear in mind on this daily chart. The first of the 3 patterns is the obvious and broken, then recently broken again last week, and this week looking like it might be repaired soon. Purple late September 24 to mid-February 25 descending expanding wedge pattern, currently 473.92, way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary, made back in January this year, and had been severely tested on the top side between late February to mid-April, enough that I would not necessarily classify it as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line, as I believe it to be significant. After the break higher, seen back between February and March and on the way back lower, I asked you 16 weeks ago to, and I quote, Also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then the market started utilizing the bright pink middle tine of this bearish shift pitchfork, first as an attractor, riding prices lower in a shallow glide until 12 weeks ago when the market broke free on the downside, but still riding underneath, or riding near I should say, to the middle tine. 5 and 6 weeks ago we saw attempts higher that failed, getting caught in the well highlighted overhead congestion between 489 even to 490.10, and then the bright green extension to the April to June 2021 head and shoulders neckline, currently 492.90, and finally by the arching approach lower of the mauve medium moving average, currently 488.30. The results of all this was an outside week 6 weeks ago, and another 4 weeks ago, and finally an outside month for July. These are not as powerful as weekly key reversals up seen in New York Sugar, or indeed seen here 9 weeks ago, but these are still there nevertheless. Now, I asked this question 4 weeks ago, and I quote, what it seems to come down to now is whether the market has the bullish incentive to push up over the pink middle tine, the purple upper trend line, and the bright green neckline extension right now. End of quote. Last week it had enough of a bullish incentive to try 2 out of the 3 of these, but prices got caught topside by the declining mauve medium moving average, and that was enough of an overload to turn prices back down, and once more today play with the pink middle tine. The breached once more purple upper trend line, and last week higher up just short of the green neckline extension. However, as I said 2 weeks ago, and I quote, there also seems to be no immediate appetite to push too far lower right now. End of quote. I also added at the time, and again I quote, it all depends on what happens between where we are now and the February 2020 high at 456.60, because I imagine under that we might see some fresh sell stop selling emerge. End of quote. Now the reference to where we are now is to the May 2017 high at 469 even, and indeed I would extend that in that it all depends on what happens now down below the February 2020 high at 456.60 and over the green neckline extension, currently at 492.90, as I suspect that despite the overall bearish pressures, we may see a sideways rectangle pattern start to emerge between about the 456.60 level below and the 493 level above. Sugar white premium. Some interesting recent gyrations here that seem to be trying to resolve themselves into a pattern. Of a dark blue uptrend, currently at 112.5, that despite being breached on a number of occasions seems to be holding up. This now ties in with the green lower tine, currently at 112.25 of the mid-November 24 to early June 25 bullish shift pitchfork, which reinforces this pattern. However, I have a fear, and it is a real fear, that the whole February 2025 today action may be trying to form a possible diamond pattern. This would be a large pattern in time and in height, roughly between just under under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye out for such a possibility. So what have we in the way of supports and resistances that may influence the market? Well, apart from the already mentioned supports below, we should very much look at the barely now declining long moving average below. It's not even gold, it's just long. The long moving average below, currently at 100 and 3/4, par and 3/4. As this interfered and in its own way held up prices this year since the market broke up over it in the middle of February. Below these, well, we don't have that much support until the congestion below starting at 85 even and stretching down to 70 even. Now topside, we do have the twin pair of overhead 50% Fibonacci lines at 128 3/4 and 131 1/4 for the July 19 to September 22 move and the August 21 to September 22 move respectively, and the congestion at 134 1/4. However, I'm not inclined right now to view these in a favourable light, as they have been breached before quite sharply, despite only once having a weekly close anywhere within them. It was, as I said 2 weeks ago, and I quote, a fairly free area overhead, but it ran into the significant 2013 high at 152 3/4 and swiftly turned back down, just as it did back in mid-April. End of quote. That area overhead up at 152 3/4 seems to be the better resistance, as the others, well, they seem to just abrade and whittle away the bullish incentive, but on their own they don't stop it, they just whittle it away.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.